Good day, everyone. This is Bill Passarotti from Palmer & K Insurance. Hope you all are doing well. Appreciate you joining today's webinar. We are pleased to have some distinguished members of the Mazars accounting firm joining our call today. For those of you that don't know, Mazars is an international accounting firm. They have offices and business in over 90 countries with 24,000 professionals. Here in the United States, they have 16 offices with roughly 1,000 professionals as well. Mazars is a high-performing, high-caliber accounting, tax, and advisory firm, and it is truly on the advisory piece where they offer the most value in the strategic advice that they are bringing to their clients. I have a personal relationship with everyone on the call from Mazars. I appreciate you all joining. For today's call, hopefully many of you are the recipients of PPP money from the federal government and are sitting here perhaps wondering what are some of the best strategies to deploy that to be as effective and strategic and successful moving forward. We will all come through this successfully, and it's with the advice of partners like Mazars that we believe you will have the greatest opportunity and likelihood of success. Without further ado, I am going to turn this over to Ryan Vaughan from Mazars. We have a lot of content and information, which I'm confident you all will find very valuable. If you have questions, feel free to use the chat box and send it to the panelists, and we will be more than happy to try to field calls throughout. And of course, there will be a Q&A session at the end. At this time, I'm going to turn it over to Ryan, and the floor is yours.
Bill, thank you for that nice introduction, and I appreciate everyone's time this morning in joining us. As Bill mentioned, we're going to cover some business and crisis planning ideas in response to the COVID pandemic, and focus on a few different areas within the government response, looking at the CARES Act and the PPP program, and provide an example. And then we're also going to walk through more business-focused consulting, which we provide to our clients to assist in managing and succeeding through these times. And before I go any further, again, I want to thank everyone for joining, and hope everyone is well and managing through the COVID pandemic. So starting out, I wanted to go through the CARES Act first. Certainly, the CARES Act has, in my mind, three different buckets of relief or stimulus. First, and what we'll cover first, is the payroll portion, and that's really looking at there's two payroll relief programs. One, the employee retention credit, and the other, the deferral of payroll taxes. The employee retention credit is an opportunity for taxpayers that are impacted by the COVID crisis to offset the employer portion of payroll tax with a refundable credit up to $10,000. The credit is 50% of up to $10,000 of wages paid to employees during the remainder of 2020. So essentially $5,000 maximum credit per employee. And one thing to note, and an important thing to note, is this program is exclusive from the PPP. So if you receive the Paycheck Protection Program loan, you are not eligible for the employee retention credit. So it gives us a one or the other here, but for larger employers that may not be eligible for the PPP program, or even very small employers who may not have significant payroll, the retention credit can certainly be an option. The retention credit is calculated by looking at a specified period in which the employer is impacted, and there's two options for the specified period. The first is that the employer is fully or partially shut down due to a governmental order, so shelter in place, closing retail, restaurants, those types of orders that have been issued across the country. And the other is a period in which there's a significant decline in gross receipts, and that's defined by as starting in the quarter in which your gross receipts are 50% less than the gross receipts of the same quarter in the prior year. So in the middle or the later half of Q2 right now, we'd be looking to, if you were to start comparing Q1 of 2020 to Q1 of 2019 to start that period, or subsequent starting in second quarter, and you'd look back. And that period extends through the quarter in which you have gross receipts greater than 80% of the same quarter in the prior year. So if you were impacted by greater than 50% loss in gross receipts in Q1, let's say Q2, your gross receipts are 60, 70%. You're still in that specified period for this credit. In Q3, you're back at 85, 90%. So Q3 would be the end of your specified period. Qualified wages, this is also broken out into two sections. So the credit is 50% of up to $10,000 of wages paid during the periods listed above. Then qualified wages for employers with 100 or fewer employees are all wages paid during the periods would be eligible for the credit. For employers with more than 100 employees, only wages paid to those who are furloughed or placed on reduced hours are qualified. So if you have people working from home or performing services still, they would not be qualified. It would only be those who are unable to work but still receiving wages. Additionally, healthcare costs, healthcare benefits paid by the employer are includable in the $10,000 of wages paid. So that's one of the first payroll aspect of the CARES Act. The second is the deferral of employer payroll taxes. So the Social Security portion of payroll taxes can be deferred through the remainder of 2020 for employers, starting with the day that the act was passed, which was March 27th, and carrying through the end of the year. And that the deferred taxes are due 50% December 31st, 2021, and the remaining 50% due December 31st, 2022. So you have up to a year and a half deferral on some of these wages. So it could be very beneficial. One aspect in the interaction with this and the PPP program, employers can defer the payroll taxes up until the point in which the loan forgiveness amount is determined for the PPP. So if you received your PPP program in early April, your 8-week period ends in early June, you can defer through that time, plus until you confirm with the bank that there's a portion of the loan forgiven. At the time that a portion of loan forgiveness is determined, you have to start paying payroll taxes going forward. That portion that was previously deferred is continued to be deferred until December of 2021, and then the remaining 50% in December of 2022. So still a significant benefit, and you still get the deferral all the way through the same period if you're using the PPP program and this deferral option. The second area of the CARES Act, excuse me, is income tax changes. So there were several temporary and one permanent relief programs placed in effect through the CARES Act. And these are looking to ease the tax burden to employers and companies during this period, and many of which are made retroactively to apply to 18, 19, and 20. So there allows you to recognize the tax savings more immediately rather than waiting till you file your 2020 return in April of 2021. So the first is the repeal of the income tax limitation for net operating losses. And this is a temporary relief from the change in the Tax Cuts and Jobs Act that limited net operating losses to only offset 80% of taxable income. They can now offset 100%. Net operating loss carrybacks were brought back into play for 2018, 19, and 20, and you can carry that back 5 years. And one significant portion of this is you can carry back a 2018 or 2019 loss at a 21% rate back into the prior rate of 35%, really generating a permanent tax savings by offsetting income at the higher tax rate with a loss in 18, 19, or 20. Additionally, the modified limitation for non-corporate taxpayers, so for your partnerships, S-corps, and flow-through entities, you're able to, the maximum loss eligible to be claimed, which was $500,000 under the Tax Cuts and Jobs Act, has been removed, so there's no limitation in 18, 19, or 20. The corporate minimum tax, which was disbanded under the Tax Cuts and Jobs Act, you're able to accelerate those alternative minimum tax credits into 2019, which previously would have been spread through 2022. The deductibility of the interest expense was increased. Again, the Tax Cuts and Jobs Act had modified Section 163J, which limits the amount of interest you're able to deduct to 30% of your adjusted income. That was increased to 50% for 2019 and 20. As the bonus, the last item here, bonus depreciation, and this was one of the permanent changes in the CARES Act, and this was a correction to the Tax Cuts and Jobs Act, which there was an error in drafting the Tax Cuts and Jobs Act, excluding qualified improvement property, otherwise called qualified leasehold improvement property. It was excluded from 15-year depreciable life, which then excluded it from bonus depreciation. The CARES Act corrected this retroactively through September 27th of 2017, which is when the Tax Cuts and Jobs Act enacted 100% bonus depreciation. So now those qualified leasehold improvements or qualified improvement property are eligible for the short life and eligible for bonus depreciation, which could significantly accelerate deductions for your tax return. For 2019, you can also look back to amend 2018, part of 2017, or file an accounting method change on your 2019 or 2020 return to capture those benefits. Wrapping up the income tax section, looks like this was a duplicate slide, so I apologize, but this, again, the deductibility of interest, bonus depreciation, and the corporate AMT. So the last section of the CARES Act that I'm going to talk about is the funding and the PPP program, which has received a lot of media attention, both positive and negative in some cases. But something that has been impactful, I know, for a lot of our clients, and hopefully everyone or people, everyone who wanted it on the phone was able to to qualify and receive the funds. So just at a high level overview, eligible businesses, the CARES Act modified the standard SBA or Small Business Administration program to include employers with 500 employees or fewer, or the number of their applicable standard size provided by the SBA. It expanded to self-employed individuals, and the 500 employee limitation was removed for NAICS Code 72, which is the accommodation, food and accommodation, NAICS Code, hotels, restaurants, etc. That was removed. The 500 employees was placed on a per location basis as opposed to an entity-wide basis. Additionally, EIDL loans can be refinanced through the PPP program if you were one of the early applicants to the EIDL program. The loan amount was calculated looking at 2.5 times your average monthly payroll for the prior year, and that could be the trailing 12 months from the application date or 2019. The loan maximum was $10 million. For new businesses, there was a measurement period of January and February of 2020, and there was also some seasonal employer options to look at different periods to maximize your loan amount. The reason the PPP received the significant attention is this loan forgiveness offering as part of the loan. If during the 8 weeks following the loan, you spend costs related to payroll, interest on mortgage obligations, rent, and utilities, those costs could be eligible to forgive a portion or all of the PPP loan. And there's been a lot of subsequent guidance and analysis that has come with the loan forgiveness portion, and a lot of strategy can go into maximizing that. Some recent updates that we've seen, and recent means as recent as yesterday. We put out a presentation, and yesterday afternoon and yesterday morning, the SBA released additional guidance. So we were on our toes a little bit, but some areas that are receiving additional attention or were clarified. One of the requirements for the PPP program was the good faith certification, in that due to the economic uncertainty related to COVID-19, the loan was necessary to support ongoing operations. This is one of the areas, the necessary phrasing. If you saw on the news, Shake Shack and Ruth Chris and the Los Angeles Lakers all kind of came into scrutiny over this as some publicly traded or backed by significant investors. The SBA indicated they may not need the loan, so several of them were given back, and I'll talk a little bit more about how that applies in the next couple slides, but really looking at adequate sources of liquidity and if the applicant does need the loan. Payroll cost, and this is on both sides, both the loan application and the forgiveness application. For employees earning $100,000 or more, they were limited to the $15,385 in the loan forgiveness calculation. So that's 8 weeks of $100,000 annual salary, and wages for this definition includes commissions, tips, paid leave. So if you're paying vacation, sick pay, as well as self-employment income. Payroll costs include gross pay, health insurance premiums, retirement benefits, and the employer's state and local taxes, employer paid state and local taxes. One thing to note is the health insurance premiums, retirement benefits, and the taxes are done at an aggregate level. They're not on a per employee level, so they are excluded from the $100,000 cap, which can be significantly beneficial for employers paying healthcare premiums and making retirement contributions. The state and local taxes haven't necessarily seemed to be that big of a number. Part of the forgiveness is the payroll costs need to represent 75% of the forgiven amount. And in the application that was released last Friday, there was some clarification in your loan forgiveness application. You take your total payroll cost, divide it by 75%, and that's the maximum. That's one of the maximum amounts of loan forgiveness that you'd be eligible for. There's also 2 clawbacks or reductions to the loan forgiveness amount. One based on your average full-time equivalent during the 8-week period compared to the prior to 2 prior periods, and that's January and February of 2020, or February through June of January and February 2020, or February and June of 2019, and the lesser of those. And your full-time equivalent is determined by a 40-hour work week. The wage reduction aspect looks to your average annual pay, salary or hourly wage during the 8-week period compared to Q1 of 2020. And it does appear to look solely at your salary or hourly rate. It doesn't include bonuses or things like that. So that was a big question we had. If someone paid bonuses for 2019 in Q1, is that going to negatively impact their wage reduction calc? It doesn't look like it. The taxable income aspect of the PPP, the forgiven amount is not included in taxable income. However, the amounts, the cost incurred for the forgiveness currently are not deductible on your income tax return. So you don't have to recognize the forgiven loan as debt forgiveness or cancellation of debt income, but you cannot deduct the payroll, wage, rent, or utility costs that generated that forgiven amount. So, and that's currently, there's been some talk in I believe both the House and the Senate in changing that, and I think the White House has pushed back as well. But as we are here today, it is non-deductible. There's some additional clarifications on the related to foreign affiliates and the 500 employee headcount. For applicants who applied prior to May 5th, the SBA will not deem them ineligible if their global employee headcount is over 500. Due to the SBA, there was some confusion with the guidance released prior to May 5th, and on May 5th, the SBA clarified, but they're not going to punish or deem anyone ineligible if they applied under the guidance prior to May 5th. Safe harbor aspect, so for loans under $2 million, the SBA has deemed that those employers or companies have met the good faith certification. So that's a favorable fact pattern, and that's $2 million including affiliates. So if you have a bunch of related parties that aggregate over 2 million, you would still need to meet the good faith requirement. Additionally, loans over 2 million will have to demonstrate that they meet the good faith requirement, as well as maybe subject to review of their loan application, as well as loan forgiveness application by the SBA. Covered payroll costs in the recent application released, it looks through the 8 weeks or 56 days following the loan date. But for payroll costs, there's also alternative period, which can begin on the first pay period following the loan date. And this is to allow, and this is only for taxpayers who make payroll payments biweekly or more frequent, so generally biweekly or weekly. If you're semi-monthly or monthly, you would not be eligible for the alternative covered period. But this allows taxpayers to match their payroll to their 8-week periods, which may be beneficial, but certainly worth calculating both ways, because there could be ways using the regular covered period that you could increase. You could make more payments during that period than you would under the alternative. It is incurred for the end of the 8-week period. There is an aspect of incurred but not paid, and as long as that's paid by the next regular pay date, you can include those days that had not been paid yet, but within the 8-week period. Non-payroll cost, again, it can't exceed 25% of the loan forgiveness amount. Looking at interest payments for personal and real property, rent and lease obligations, and utility payments. Interest and rent and lease obligations would need to be in place at February 15th of 2020. So if you started a new lease or a new mortgage, you likely would not be eligible. Additionally, prepayment of mortgage interest is not eligible. So I'm running up on my allotted time here, but a couple other things. There were exceptions in the headcount reduction or clawback for laid off employees who did not wish to return in the offer of rehire, employees fired for cause, or anyone who voluntarily left the company or voluntarily reduced their wages. You're not going to be penalized by that, as well as there's an exemption if wages and or headcount are restored by June 30th. You're able to offset the related or both potential clawbacks. I mentioned the payroll tax deferral up until the loan forgiveness date. Earlier, the 8-week period looks again to at the end, if you're incurring those costs but haven't paid yet and made that payment within its normal scheduled pay, and the next pay, you can include some of those costs in the 8-week period. And the 75% rule we wanted to highlight here again. There was some conversations of if you didn't meet 75% of your costs being payroll related, you were ineligible for any forgiveness. That is not the case, and the SBA clarified your forgiveness amount is just capped at your payroll cost divided by 75%. Here, I just wanted to highlight it. I'm just going to go through this quickly because I'm running a little bit over. This was a tool that Mazars developed in helping companies and our clients calculate their loan amount. And we also have loan forgiveness aspects of this. And certainly you can look here and see managing the headcount reduction and what that means. And here we're taking the lesser of the option A and option B, which in this case, we actually have an increase in headcount. So there's no headcount reduction. The June 30th cure date, we have a drop-down box here in the middle that allows you to offset potential clawbacks if you can bring back the headcount or the wages by June 30th. And the wage reduction in this model and part of what you'd be looking to potentially do to maximize your forgiveness is analyzing what's going to be paid during your 8-week period, and if you have the opportunity to pay a bonus or increase pay during that 8-week period to maximize your forgiveness, or maybe catch up some wage reduction that employees may have incurred prior to the 8-week period or prior to the PPP funding. You can certainly push that through, increase your loan forgiveness amount, and try to make your employees whole. Really, the intention behind the CARES Act as a whole, but certainly the PPP is to keep people employed on the payroll in hopes that when we do open up, or as we're starting to open up now, people can kind of get right back in and start working. And with that, I will turn it over to Paula. And I am.
Perfect. Thank you, Ryan. Good morning, everyone. Thank you, everyone, for joining, and thanks to Palmer & Kay for the opportunity to share this information. As you can all see, the PPP and forgiveness is something that we are still consistently receiving guidance on. And Mazars, we believe that the strategy and being proactive is what makes the difference to all of our clients. We have a hands-on approach and believe in partnering with our clients to ensure that the best results are received. When we partner with them, we are able to assist in meeting their goals and objectives. For these reasons, I would like to speak on how I approach the PPP process with a particular client. I have a client who is a distributor with more than 100 employees and historical sales of over $75 million. They were impacted rather quickly with COVID and felt their sales drop suddenly in mid-March. Immediately, we called them and strategized about headcount reduction, costs, and the next steps. We stayed in close contact with their banker and ensured that they always had the most updated information and were able to submit the application as soon as it became available. We all know how difficult that process was. In doing so, we were able to maximize the loan by capturing all the allowable expenses. This was tricky as there were many interpretations out there, but we had a team that digested the CARES Act and gave us guidance on a daily basis. As you could see from the tools that Ryan shared, we had tools in place also to ensure that our clients were receiving the maximum loan amount. The thought process was always to maximize the loan, improve cash flow, and put the company in the best cash position possible. Throughout this process, we also estimated the forgiveness calculation with various scenarios. Thankfully, this client received their loan rather quickly. After their loan was received, we began having weekly strategy meetings via Zoom with the client. We're currently still having them pretty much on a weekly basis in the evenings and whenever it fits for them. As the business advisor, we continue assisting them with business decisions, walking them through the process and computing the PPP forgiveness with salary reductions and looking at all our non-payroll costs to ensure that all allowable expenses are always being captured. We are also able to be flexible and nimble and tweak the process along the way. Currently, we're estimating about 80% of their loan to be forgiven. We are now beginning to discuss with them what happens after COVID. We are speaking to their bank, assisting them with cash flow projections, and ensuring that the company is in as strong as possible a position as things begin regaining some normalcy. Unfortunately, COVID has given us a new normal and made our lives a little more difficult. However, we found that being strategic and proactive gives us the best options to always help our clients. This is a type of guidance that we offer all of our clients, not just the one I spoke of. We partner with our clients to help them achieve their goals and walk hand in hand with them throughout the process, taking a strong advisory role. At this point, I wanted to turn it over to Alisha Jernack, who will speak about some of our post-COVID strategies and advisory tools. Alisha has also supported many clients throughout this process.
Thank you, Paula. Just 1 second here. I want to share my screen, and there we go. Can everybody see this slide? I just want to make sure that this is showing up correctly. Okay, so to get started, as Paula mentioned, I would like to give an overview here of our Mazars Business and Financial Sustainability Program. We've personally been doing this with a lot of our clients, whether they are significantly impacted because they're either in the restaurant or retail industry, or even others who are not impacted severely, but there's certainly some uncertainty when looking past this and down the road into the near future. So with this program that we've developed, we're looking at a few things here, and we look at this in phases. And we've outlined it here, the 5 different phases that we look to. The first being we want to assess your pre-crisis track record. And we do this because we want to understand what the business looked like before. We want to look at your historical financial statements here. What did your balance sheet look like? How did you compare your key ratios against benchmarks and others? And do you even have the ability to sustain this crisis? So we'll look to that. And then once we've looked past that, we'll generally look at a 3-year period. We're going to look to do a impact assessment. And here we're going to look to understand what is the impact, what impact has this pandemic had on our business? And again, of course, this really does depend on industry. Some, again, are really going to be severely impacted and shut down for, a 6 to 12 month period potentially, and others are able to operate through this as essential businesses, but certainly things are not the way that they were prior to this pandemic. So we're going to look to assess the impact, and while in this phase, we're going to break this out into a timeline. We want to look at, what does this look like today, and what is today? So today, depending on where you are, most of us are in lockdown. So we would call that, the lockdown phase. And then we would look to, 12 to 18 months from now, if we're able to operate, that might be under, some social distancing standards. So what does that look like? And how do we assess the impact there? And then lastly, we look to the recovery and what does the recovery look like for us? And then we head into our priorities and our strategies. And here we really want to understand the priorities of the shareholders and make sure that they are aligned so that we can best help them to plan for this. And we want to identify key strategies for our crisis action plan to help us through this. Then we would get into our second workshop where we would together develop our crisis action plan, again, based around our shareholder priorities and the identified strategies. And then, of course, we would build that into a revised forecast and financial plan, because in identifying these strategies, these initiatives, and these, targeted outcomes, we want to look to see what is the impact of each of these. We really want to get granular and look to how is this impacting our sales? How is this impacting our costs? What investment, if any, is needed? What does our working capital look like? Do we have cash? And then lastly, this is something that is a long-term project. Minimally, we see this journey being 12 to 18 months where we're working with our clients to continue to execute and monitor, and of course, adapt and modify our plans if necessary and where need be. So here, this just summarizes everything that I just said to you. Again, the purpose and the benefits of this is, one, of course, to assess the financial impact of the crisis and develop realistic scenarios based on projections, to assess if the business has sufficient profit levels and cash flows to continue on the day-to-day, to look at, best case, worst case, and most probable. We want to look to make sure that we're managing key relationships and maintaining our longer-term competitive advantage to the extent that we can. And we want to be able to communicate back to our professionals, whether it be, the bank, other board of directors, or other stakeholders. Having this plan in place, it really allows you to provide them the assurance that they're looking for during this time of uncertainty. And, we're hearing about this day in and day out, where banks are concerned. They want to see some sort of financial projections. They're not necessarily accepting to just see a projection with assumptions, sales are going to increase by 5% and my gross profit margin is going to stay the same. They're really looking to see plans that have been tailored for the specific circumstances today. And we're finding by showing best case, worst case, and most probable, and sharing that with our key relationships, they're seeing a lot of value. And by staying in front of it and being proactive and having these conversations up front, it's really truly helping our clients. And they're staying in front of any questions that are, it's inevitable that those questions are going to come at one point or another. And, we're looking to provide a crisis management framework and integrate those revised financial plans to allow everybody to be comfortable and continually assess the scale of the crisis and continue to track it on an ongoing basis. That's really key here. And that's often where we see that these things, fail or fall through the cracks, is it's not properly executed and managed. So you may have a plan that you've put together, but how frequently are you revisiting it and making changes to it? And, are the assumptions that you used a month ago, are they the same today? Or, has something changed in your supply chain? I mean, we all see all the disruptions and things are changing truly on a daily basis here. And we want to make sure that the commercial direction that would have been in our original business plan and how we were operating 6 months ago, clarifying that and making sure that, that still exists and makes sense for us today, because it may not. We may have to pivot and shift and, it might be modifying our business plan or looking to a whole new commercial direction. So the key areas that we generally are going to look at, of course, here on the screen, you can see sales and having realistic sales projections and considering the ongoing uncertainty and the changes. Cost basis, I'm sure many of you have already looked to your costs and what costs can be cut and how do you manage that, and what costs can be cut to maintain, your normal operating levels without really disrupting your business too much. Looking to your working capital, and is there some sort of additional investment that may be needed or cash injection? Looking to, protecting your bottom line, your cash, and managing, shareholder returns and long-term value, again, to the extent that you can. We want to protect that. We want to protect your competitive edge, your competitive advantage. We want to have a plan in place today, so a year from now, when hopefully we're on the path of recovery, our brand and what was known of our brand, that is still there, that still exists for us. And then here, I'll skip over this, just touch very, very quickly. This comes later, of course. Everybody has to consider health and safety, shortfall cash implications. That, was everything that Ryan and Paula just talked about. Hopefully many of you received the PPP money and now you're looking to strategize to get that maximum forgiveness. Hopefully you've had meetings with your management team, and now it's time to really put together that crisis survival plan, and then not forgetting about the execution and the monitoring. So here, this just goes into a little more detail of the program as I just described it for you. Phase 1, looking at that pre-crisis track record. I have some slides in here that I wanted to share. We put together a case study, and this was based on a real client. So just to add some color and context to this, this is what this could look like. So here, what we're showing on the screen, this is a pre-crisis background. This is a restaurant client. So we're showing here what their business looked like before the pandemic hit. This was a new business in 2017. So this was just the beginning for them, and they were heading on the path of growth. So we're showing here a snapshot of just the P&L and the balance sheet. Here we're looking at, as I mentioned, we want to look at your key performance indicators, and we want to look at the trends. So we've shown this here. Again, I didn't include the background slide, but this was a restaurant. This is a restaurant and a fairly new restaurant. So we were showing this is what you looked like before. This is the path that you were on, and having conversations about how we interpreted this before the crisis. And then you would go into your phase 2, your impact assessment. And again, here we would want to look to realistically, what does the business look like today? What is the likelihood and timeline for when we can get back up to operating in the way that we were pre-pandemic? This is another slide from the case study, and this just shows us here, our cost pools. And what we would want to look to here, and what we did look at here, was if we're shut down for a period of 12 months, what's the bare minimum fixed cost that we need to maintain over the next 12 to 18 months? If we were to shut down and do nothing, what are the costs that we have to carry? What is our starting cash balance today? And how long is that cash going to last us? At what point in time are we going to run out of cash if we only continue paying our fixed costs? And in considering fixed costs, does that include rent? Does that include rent plus utilities and insurance? Is there any payroll that is in there, management payroll, owner pay that we're going to continue to pay over the next several months? We need to get very, very comfortable with our fixed costs and our opening balance sheet to be able to project out based on, historical information. And as of the day that this pandemic hit, we were to just pay those fixed costs, how long is that going to last us? So that's what we did here to break down the costs and really get a good understanding. Then here is just an example of how we identified the timeline and broke this down for our clients. So we looked at, pre-crisis and when they shut down in mid-March. And then we looked to how long realistically did we think that they would be in full lockdown mode. And we said that was, of course, mid-March, and we put on here, we agreed to, that's likely not to be a downer here, but could be, August before we see restrictions really lifted. And then we wanted to say, what is the period of time under which is realistic to think that we could be operating under certain restrictions? So we called that the social distancing phase, and said that would be another 12 months. And then lifting of the restrictions, onto our recovery. And we wanted to map this out again, because this all leads into that revised financial model, which becomes critical, to mapping this all out and seeing what the impact is on your cash, on your balance sheet, on your working capital, and how do we manage this? Here we go into just show, so this is looking at after the initial mitigation, meaning we closed our doors. So this was just a quick snapshot of, this is what we looked like, coming into 2020, we had our projections, everything was healthy. We were looking to generate a profit of $336,000, but we had to shut our doors. And now if we continue to remain shut, we're likely to see a loss of, could be almost $350,000 here. Same thing here, we're just showing a snapshot of the balance sheet. Again, this is critical, very important. We need to know what our opening cash is and how long that cash is going to last us. We need to know what debt do we have on our balance sheet and what is our fixed service charge over the next several months. What obligation do we have to pay our vendors over the next several months? And then we get into our management priorities and strategies. And again, we need to consider here our cash flow. So on this slide here, and I'm just going to stop for 1 second because I think there may be an issue with my slides. Audrey or Bill, are you able to see my slides? Okay, I'm going to continue. I don't know if there's an issue. Maybe it is delayed, but hopefully everybody can see my slides. So on this slide here, what we're showing is these are the priorities that we would typically look to, and we would work with the management team to have them go through and really rate, what are the priorities for them. We can certainly, sorry, I think there's an issue with my slides. So we can, I'm just going to keep going.
Alisha, this is Bill. We can now see all your slides. We were having an issue, but they are now live. So please continue.
Okay, thanks, Bill. So, we can certainly help management to go through this, but we want them to really go through and tell us what are their priorities, because we can't effectively build a plan if we don't understand what their priorities are. And each one of, each company is going to have different priorities. So for some, it may be profit and maintaining a competitive advantage at all costs. Others, they may not have any risk appetite, so they may just want to sit there and do nothing, be very, very conservative, understanding what their cash balance is and how long that is going to last them. Others may be willing to take on additional debt and look for investors or other opportunities to have additional funding and support to help them to carry on. So this is a very important step as we go through this process, is to really truly understand, and then, of course, to make sure that management is aligned as well. And, these are some options that we would typically look to today, specifically for our crisis action plan and with this financial sustainability program. Some of the options we've laid out is, of course, you can liquidate. So what does that look like for you? You can close temporarily, and how do you define that? How long do you close for? Are you able to open and look to new channels for distribution or, some other business model altogether? Do you downsize? And, if you were previously operating with 50 million in revenue, are you able to sustain operations and profit levels with 20 million? Do you need to just enhance your existing model? So these are some of the options here that we would generally look to with our clients. And bringing it back to this case study that we went through, these were the three that we looked at. So this was the timeline we showed earlier, looking at, closing down temporarily. And here we put that as the 12 to 18 months. We looked at the option of, well, what happens if we do something, if we open under, with restrictions under a different business model? And lastly, what happens if we liquidate, and what does that look like for us? And, what is the return to the shareholders, if any? And these I'm going to click through quickly. This just, again, gives a snapshot of the different options. So here is what we would typically, walk through and show, and we have to consider our assumptions here. So we show with each option, we go through the P&L, your balance sheet, and your cash flow. So that's summarized here. And this was under the first option that we wanted to look at, which was closing down for a period of 12 to 18 months. We wanted to see what was the impact on our balance sheet, on our cash flow, on our profit and loss statement, while considering the shutdown for 12 to 18 months. And then we looked at option 2. What assumptions do we use, and how do we build the financial model around opening with restrictions or under some different business model? Again, looking at our balance sheet, our profit and loss, and our cash flow, and what is the impact on all of that, and looking out, not just over the next 12 months, but really dragging that on to look over the next 4 or 5 years. And then lastly, looking at, what happens if we liquidate, and are we actually walking away with any money, or are we losing money? And then this slide here summarizes the different options that we presented and went through with our client. And we looked at this for a period of 3 years to just summarize the snapshot here. Here we look to, we had identified our shareholder priorities, again, critically important that we do so. And in each of the options that we're considering, we need to assign a risk factor. How risky is it for us? Because, if there's a lot of risk, you're going to consider that and, weigh that into the equation when you're building your financial model. So here we listed out the 4 identified shareholder priorities and each of those strategic options that we were looking to. And, are we meeting the shareholder priorities that we set out when we started this or not? And, this was important and great for them to see and really helped them in making, the decision as to where they wanted to go and, what needed to be done next. We also presented this decision tree here to assess the realistic options to go forward. And it almost sums it down. You just go through and you can take a step back and ask these questions and see where it brings you. So the result of this particular case study was that, we knew we didn't want to liquidate. We weren't sure if, it was viable to just remain shut and do nothing or to do something, really until we started this process and started to put the pen to the paper and see what this all looked like. But we ended up looking to do something. So, that brought us into our crisis action plan phase. And now we're building, the revised financial model with them. We've identified the strategies to get us there and to carry us under this revised model over the next several months until we really are on the path of that recovery phase, which we'd go back to our timeline and look at what that realistic timeline is, and we'll certainly have to adapt to that as more time goes by. So here what we're showing is, we had identified the priorities and the strategies. We completed our assessment and we decided that we were going to remain open, but it was going to have to be under a revised business model. And these were the strategies that we put out on the table. And now we have to look to build that revised plan. So here we had defined the revenue streams and the sales channels to do so. And as I mentioned, this really brings us into the crisis action planning. And then lastly, the revised financial plan where we'll forecast the revenue. We're going to look to the operating costs and the margins, and again, making sure that they're realistic. And even looking at best case, worst case, most probable, we're going to look to, what are the overhead costs and, what does that look like on our balance sheet, our cash flow, and our P&L, and is there additional investment required? So this summarizes the next steps and brings us into, of course, can't say enough, the execution and monitoring stage. I know we're going a little bit over on time, so I am going to skip ahead and pass it back over to Bill.
Alisha, thank you so much. And for those of you that were having an issue viewing some of the slides, we will be sending out all the slides individually to you. And of course, offering to make any introductions to the team at Mazars. One question that we did have that remains unanswered, and I will open this up to anybody at Mazars that would like to field it. One of our attendees sent a private text regarding expenses that took place in 2019 or early 2020, such as a utility bill. Is he able to apply money received during PPP to pay expenses that occurred prior to the COVID outbreak?
Bill, I can answer that. So the and can you hear me? I think
yes.
I'm muted. Okay. So I think the answer to that is most likely no. Especially if the costs were paid prior to the 8-week period. Now, if you had a bill in from February, you got the PPP loan in early April, you hadn't made payment on that utility until mid-April, you could maybe make a claim that it was paid during the 8-week period. But I think that's going to be really on both ends of the PPP, the goal is to have the cost incurred during the 8 weeks, so you're not prepaying or I guess in this case late paying.
Okay, that's helpful. At this time, we have no additional questions coming from the field. Again, I want to thank our presenters, Paula, Ryan, and Alisha from Mazars. To everyone listening to the call, we appreciate your time today. Hope this was informative. We wish you well, be safe, and talk to you all soon. Thank you.